Okay, let's dive into this. We're looking at the Registered Retirement Savings Plan today, the RRSP.
Right. A cornerstone for a lot of Canadians saving for retirement. But it's got layers.
Definitely. So our mission here is to sort of cut through some of that complexity, find the really key things you need to know for your situation.
Exactly. At its core, it's a savings plan registered with the CRA. Helps you build retirement income.
And the big draw is the tax advantages, isn't it?
That's the main thing.
Yeah.
You generally get a tax deduction when you put money in, and then the investments inside grow tax deferred.
Tax deferred meaning you don't pay tax on the growth until you pull the money out later.
Precisely. So let's unpack that deduction first. It's pretty powerful.
Yeah, tell us about that. How does it work?
Well, when you contribute, that amount usually lowers your taxable income for that year.
So you pay less income tax now?
Right. And this benefit is generally bigger if you're in a higher tax bracket currently. Saves you more tax per dollar contributed.
Okay. And then inside the plan?
Inside, all the earnings, dividends, interest, any capital gains, they just compound. No tax drag year after year.
Until withdrawal. That compounding effect over, say, 20 or 30 years must be significant.
Oh, it's huge. That tax sheltering really boosts long-term growth potential.
So the practical question, how much can you actually put in each year?
Good question. It's based on your contribution room. Generally, it's the lower of two numbers. 18% of your earned income from the previous year.
Earned income, like salary, right? Not investment income.
Correct. Salary, net business income, things like that.
Yeah.
So 18% of that, or the annual dollar limit set by the government. For 2025, that limit is $32,490.
Whichever is less.
Whichever is less.
Yeah.
And then, importantly, you subtract any pension adjustment, or PA.
That's if you have a pension plan at work.
Exactly. The PA reflects the value of the benefit you earned in your workplace pension that year, reducing your RRSP room accordingly.
Okay. And what if you don't use all your room?
It carries forward, so you can accumulate unused room from previous years, which is handy.
And there's that little trick with the first 60 days of the year, too.
Right. Contributions made in January or February can be deducted against the prior year's income, giving you some planning flexibility around tax time.
But you have to be careful not to put in too much, the over-contribution penalty.
Yes, that's a key pitfall. There's a small $2,000 lifetime buffer. But go over your limit by more than that, and you face a 1% penalty tax per month on the excess amount. It adds up fast.
Ouch. So checking your notice of assessment from the CRA is crucial.
Absolutely vital. It shows your official RRSP deduction limit for the year. Don't guess.
Okay, let's switch gears. Taking money out, the withdrawal side.
Right. Generally, when you withdraw from an RRSP, that amount gets added right back into your taxable income for that year.
So the tax deferral ends and you pay income tax then?
Correct. Plus, there's usually withholding tax taken off right away. It's like a down payment on the tax you'll owe.
How much is that?
In most provinces, it's 10% on withdrawals up to $5,000, 20% for amounts between $5,000 and $15,000, and 30% for anything over $15,000.
And a really important point, unlike a TFSA, if you withdraw, you don't get that contribution room back, do you?
No, you don't. For regular withdrawals, that room is gone forever. It really highlights that the RRSP is meant for long-term retirement savings.
But there are a couple of major exceptions for withdrawals, right? The home buyer's plan.
Yes, the HBP. First-time home buyers can withdraw up to $60,000 each, tax-free, to put towards a down payment.
That's a big number now, $60,000.
It is. The catch is you have to repay it back into your RSP over 15 years, starting a couple of years after you withdraw.
And the lifelong learning plan, similar idea.
Similar idea, yeah, for financing full-time education for yourself or your spouse. Similar withdrawal limits and repayment terms, though used less often.
Okay, this brings up the big comparison question. RSP versus TFSA, and now the FHSA too. How do they fit together?
It's a common question. Think about the timing of the tax break. RRSP gives you the deduction upfront. You save tax now.
Betting you'll be in a lower tax bracket in retirement when you withdraw and pay the tax.
Kind of, yeah. The TFSA is the opposite. You contribute with after-tax dollars, so no upfront deduction.
But the growth and withdrawals are completely tax-free later.
Exactly. And you get TFSA withdrawal room back the following year. More flexibility there.
In the first home savings account, the FHSA, it's like a hybrid?
It really is. For that specific goal. You get an RRSP-like tax deduction when you contribute.
Really?
But if you withdraw for a qualifying first home purchase, it's tax-free, like a TFSA. And no repayment needed.
Wow. Best of both worlds for a home buyer. What if you don't buy a home?
Then the money can be transferred tax-free to your ROSP, or RRIF, without using up any existing RRSP contribution room.
So choosing between them depends on your income now versus later, your goals.
Your goals, your tax situation, your need for flexibility, often using a mix of accounts makes sense.
And eventually you have to do something with the RRSP, right? You can't keep it forever.
Correct. By the end of the year you turn 71, you must convert your RRSP, usually into a RRIF, a registered retirement income fund.
Or an annuity.
Or an annuity, yes. With RRIF, you have to start making minimum taxable withdrawals each year.
So planning those withdrawals becomes important for managing retirement income and taxes.
Absolutely. Coordinating RRIF withdrawals with CPP, OAS, TFSA funds can impact your overall tax rate and even things like OAS clawback.
Right. So, wrapping this up, the RRSP is clearly a powerful tool that tax deferral is key.
Definitely. But getting the most out of it means being strategic, contributing smartly, avoiding those penalties.
And really thinking about how and when you'll use the money, especially alongside TFSAs and FHSAs, it's about the whole picture.
It truly is. It's not just save and forget.
Which leads to a final thought for you listening. When you look at the trade-offs tax break now with the RRSP or FHSA versus tax-free access later with a TFSA or an FHSA home withdrawal, are the savings tools you're using today really lined up with what matters most to you, both in the short term and for the long haul?